The cryptocurrency landscape is exhibiting distinct signs of a late-stage cycle consolidation, with Bitcoin's price discovery encountering strong resistance and Tether's role amplifying risk aversion. We must examine the current technical structure and liquidity metrics without repeating previous commentary or analysis points. The market mood has shifted from aggressive optimism to cautious observation, a change driven by global financial dynamics. Bitcoin is consolidating within a tight range, specifically oscillating between $87,000 and $89,500. This narrow price action follows a sharp rejection that originated near the $93,000 zenith. This failure to breach the $93,000 level establishes it as a formidable overhead supply zone, attracting significant short interest. The immediate technical concern centers on the rising wedge pattern observed on the 4-hour chart. A breakdown from this pattern, which typically signals bearish continuation, could quickly push Bitcoin toward the pivotal $85,500 support level. This $85,500 mark is critical as it aligns precisely with the volume-weighted average price of the past 6 weeks, indicating where the average participant holds their position. Losing this level would initiate a wave of forced selling and a probable decline towards the $2,500 demand zone. From a macro perspective, the realized capitalization of Bitcoin has recently shown a minor divergence from the market price. While the price has struggled to hold gains, the realized cap, which tracks the value of all coins at their last on-chain movement, continues its gradual ascent. This suggests that despite the short-term volatility, the underlying cost basis of the long-term investor pool is still moving higher. This discrepancy highlights the battle between short-term speculative selling and long-term accumulation. Furthermore, the number of Bitcoin held on exchanges has stabilized after a period of outflow. This stabilization indicates that institutional investors may be pausing their accumulation or engaging in subtle rotation within their digital asset portfolios. The funding rate across major perpetual futures exchanges has turned marginally negative, confirming that short positions are now dominant in the derivatives market. Tether or USDT remains the paramount stablecoin, and its behavior offers crucial insights into capital flight. The key metric to watch is not the dominance percentage, but the growth rate of the USDT supply relative to the total supply of the top 3 decentralized stablecoins. This relative metric shows a clear preference for centralized, fiat-backed stability in the current environment. The growth rate of USDT supply has accelerated over the last 3 weeks, outpacing that of its decentralized competitors. This signals that new liquidity entering the market is disproportionately choosing the most secure harbor, reflecting deep caution. Investors are not seeking high yields in decentralized finance pools, but rather absolute safety in a fully reserved stable asset. The analysis of USDT issuance patterns shows large block mints occurring predominantly during Asian trading hours. This suggests that significant institutional capital, possibly from East Asian entities, is preparing to enter the market but is actively sitting on the sidelines in USDT. This stored liquidity represents an immense potential buying force, but its delayed deployment is suppressing price action. The velocity of USDT on-chain is also decelerating, meaning the stablecoin is being transferred less frequently between wallets. Low velocity implies that the token is being held for longer periods, rather than being actively used for trading or transactions. This reduced trading activity confirms the prevailing wait-and-see approach among major market participants. In summary, Bitcoin is navigating a period defined by technical vulnerability at $85,500 and a derivatives market leaning bearish. Meanwhile, Tether's accelerating supply growth and decelerating velocity underscore a market-wide liquidity pause. The critical factor for the next major movement lies in when this stored USDT liquidity decides to re-enter Bitcoin. Until that shift occurs, the path of least resistance for Bitcoin appears to be downward toward the lower band of its established trading range. Bitcoin and Tether Ecosystem Assessment, December 2025. The digital asset ecosystem is currently characterized by a deep sense of strategic ambiguity as year-end approaches. Bitcoin's price trajectory reflects a struggle for directional conviction, while Tether's dominance metrics reveal underlying capital flows and trader psychology. This new analysis will focus on different on-chain indicators and market depth observations, strictly avoiding previous narrative points. Bitcoin is traversing a descending channel on the weekly time frame, a pattern that suggests the immediate path is one of lower highs and lower lows. The price is currently trading around $8,000, clinging to the midline of this channel. A significant element of the current market structure is the massive liquidation level identified at $84,000. This level represents a clustering of long positions that could be swiftly liquidated if selling pressure increases, potentially triggering a cascade effect. The key to mitigating this risk is a sustained close above the $90,000 resistance, a level that has been a magnet for price over the last several weeks. Observing the market profile, the point of control for the recent 3-month period is situated at $87,500. This volume point signifies where the most trading activity has occurred, confirming it as a psychological anchor for the market. A prolonged stay below this point suggests that the majority of participants are now underwater or nearing their break-even point, increasing the likelihood of capitulation. Furthermore, the dormancy flow metric, which measures the average age of spent outputs, is exhibiting a slight uptick. This uptick implies that older coins are beginning to move, an action typically associated with long-term holders taking profits or rebalancing portfolios at these elevated price levels. This selling pressure from aged coins must be absorbed by new demand to prevent further price erosion. Tether or USDT continues to be the dominant liquidity provider, and its performance relative to total exchange reserves warrants attention. The percentage of total crypto exchange reserves held in USDT is near historical highs. This phenomenon shows that a significant portion of capital is being held in stablecoin form on centralized exchanges, ready for deployment. This high reserve percentage is not necessarily bearish, but indicates that traders are maintaining high liquidity ratios. They are prepared to execute trades rapidly without having to bridge funds from external wallets. The Treasury issuance schedule for Tether also reveals a change in pace. Instead of large, infrequent mints, recent data shows smaller, more consistent issuances spread throughout the week. This shift suggests a broader, more continuous demand for stablecoin liquidity from various trading desks and platforms, rather than sporadic large institutional entries. This slow and steady growth in supply acts as a constant, underlying support for market capitalization. However, the stability of the stablecoin is also being tested by the growth of decentralized counterparts that offer higher yield opportunities. Despite this competition, the network effects and regulatory clarity associated with USDT continue to draw the largest pools of capital, reinforcing its central role in trading pairs. In summary, Bitcoin faces technical headwinds from a descending channel and a crucial liquidation cluster at $84,000. The willingness of long-term holders to spend their aged coins adds to the supply overhang. Concurrently, Tether's high percentage of exchange reserves and consistent supply growth characterize a market positioned for a potentially explosive move, but currently locked in a waiting game. The breakthrough or breakdown of the current range will be dictated by the movement of this highly liquid USDT reserve.